Thank you for tuning in to another episode of Retire Right. I'm Ryan Wyatt. Per usual, I'm joined by Nick Lewandowski and Ron Wyatt. The three of us together are wealth advisors here at the firm. Ron and Nick work together on the investment committee. We did a little seat change around. Figured that we would even the playing field in terms of height between Ron and Nick. So, gentlemen, how are you?
Doing well. Last recording before the holidays.
Yeah. Do you guys have anything fun? Well, Ron and I, we kind of do the same thing. But Nick, anything fun planned?
For the holidays? Yeah. Nothing special.
Yeah.
Just the little one's a year older, so.
We do the Christmas Eve, 7 fishes, a bunch of Sicilians at my parents' house. So
it's a roll. 30 plus people.
It's a roll of the dice in terms of how loud and volatile it gets there. But
well, it's not a roll of the dice. It's guaranteed to be loud. It's just how loud.
Yeah. But I'm looking forward to it. And then we have the company, the annual Christmas party tonight, which will be fun. So. Today, what we're going to do is we're going to take a deep dive on life insurance. We will talk about, what life insurance is used for, how much you need, and how it fits into kind of different stages of life, from a general suitability standpoint. So what I'll do is I'll start with Nick, and per usual, we're going to start higher level before we start drilling down here. Nick, what would you say is like the main purpose of having life insurance, and why are people buying life insurance?
3 areas at a high level that are driving insurance needs. First, income replacement, so protecting family, typically spouse and children, so that if you or spouse passes away, there's resources there to support them and other goals that need to be covered. Estate planning. So sometimes, depending on the composition of an estate, insurance is helpful or needed to provide cash for expenses or taxes, depends on the situation. And it can also help avoiding asset sales at the wrong time to create tax and provide some flexibility there. So there's an estate planning component potentially, and also business planning. So, if we were in a partnership, we own a golf course together and we're running it.
That'd be pretty sweet.
We'd use insurance to make sure that if something happened to one of us, we might not have to be in business with each other's, significant others.
Right. And we'll get into this later, but there's, of course, there's 2 different lenses to think about income replacement, through, and one lens would be, in your younger years when you're working, using insurance to, God forbid, something happened to, let's say, the primary earning spouse. Insurance could help replace that loss of income that they have. And then, of course, if you go with like a longer term, like whole life policy, for example, that could be used to maybe help with income replacement or liquidity needs, let's say like in retirement, for example. Mm-hmm. So there's different lenses to look at those through. Now, what are the main, and I'll stick with Nick here, what are the main types of life insurance? And I guess like maybe if you could bunch them into like broad categories. I know there's kind of like 2 main categories.
First category is term, which lasts for a set period of time. Payments are made, and then there's a benefit. I think we're going to talk more about it probably in a little bit, but that's the highest possible level. And the next is permanent insurance, which think of it like buying a house, like you buy it and then it lasts forever, like an asset. It has value. There's a lot of nuances with permanent insurance around how that value changes over time and potentially how the cost of it changes over time. And the 3 main types, at least that we're going to discuss in this podcast, are whole life, universal life, which gives you a little more flexibility than whole life, and then indexed universal life, which adds a couple more twists onto the universal life.
Makes it more complicated.
Yeah, basically.
So we're looking at term insurance. That's insurance for a specific period of time, and then we're looking at permanent insurance, which again, it's like we're looking at like lifelong insurance, and under that permanent insurance, you would have whole life, universal life, and indexed universal life.
That's right.
So let's start kind of unpacking those different types of insurance. Ron, we'll start with term life. What is term? I guess Nick already kind of defined it, but maybe take it a step further. And what's it used for? Who's it for? The pros and the cons, that kind of stuff.
Yeah. So as term implies, there's a specific term that lasts for 10, 20, or 30 years, right? Mm-hmm. And there's no cash value buildup. You're just buying pure insurance. That's it.
Okay.
So because of that, the cost is lower. It's very simple. Okay. What it's really designed for is like a younger family, maybe with children, and they have adequate income, but they don't have a lot of discretionary income, right? And so this gives them the most bang for the buck, right?
Gotcha.
So what you can do is get, maybe you can get 2 policies, right? Maybe 2 $500,000 or 2 $750,000 policies. One might last until your children are out of the house, right? And the other may last a little bit longer until you're 55 or 60, so that if something happens to you, if you have a spouse that's not working or maybe not as gainfully employed, it could cover them. So it's great for that.
That goes into that income replacement piece that we were talking about earlier. And I think it would be helpful. You mentioned cash value, term insurance, no cash value. Could you just define the cash value?
Sure. The cash value, when I get into permanent, I'll cover that. Just one thing on term, and then I'll get there. So the cons, of course, is it does expire. It's not permanent, right? And that's not necessarily a negative. You just have to make sure that you're getting the right amount and the right type. Okay?
Right amount, right
of coverage,
and right duration of coverage.
Yes,
as
exactly.
Well. Okay.
Yeah. So to answer your question, with permanent insurance.
And what happens if you, on that con side, let's say you buy it for 20 years, and something happens on year 21?
There's no coverage.
Okay. Yeah.
Okay. So make sure you plan up front.
Right. So there's no value. Simply said, there's no value if you outlive it.
Build a little margin of safety into your time frame
Yes.
estimates.
And what I did, like for our situation, our family situation, I bought 2 policies to cover, period 1, when children are in the house, and then period 2, just to make sure there's enough for retirement.
Perfect.
So permanent insurance, you had asked about cash value. So permanent insurance, like the name is, doesn't end. And it can, some of them can build cash value, some not. Now, cash value is just, okay, so let's just say you have $500,000 coverage and the cash value is $200,000, okay? Upon death, you don't get 500 plus 200, you just get the 500 of death benefit, okay? What the cash value can do is you can take loans from that to use it for other purposes. Now, I don't necessarily think that's always the best thing to do, but it is there in case you need it, and you can take tax-free loans.
So how is that cash value, accumulating over time from the 0 when you first buy the policy to the 200,000 in the example that you used?
Yeah, very good question. So let me just compare it to term. So term, you're simply just buying term. The only cost you're paying is the cost for insurance.
Fixed premium.
That's it.
Yeah.
So with whole life, you're buying insurance. Think of it as almost like a term policy, and you're putting extra money in that can build cash value over time. So you're paying extra, and that extra can build cash value.
Now, are you saying that cash value is a use it or lose it benefit?
Well,
since it's not paid out to the beneficiaries of the policy, the death benefit's the only portion.
Upon death, yes. Again, my example, $500,000 of death benefit, 200 of cash value. You don't get 700, you get 500, right? So it gives you some flexibility to take loans from it. I'm not a big advocate of that. I think that you get term and invest the rest. That's my preference.
Sure.
But in certain situations, it can make sense.
Okay.
So the types are whole life, which is the most guaranteed. You make a certain payment, you'll have a death benefit, the cash value can grow, and actually what's interesting is that because you're making extra payments for this certainty, your death benefit can increase over time as well as your cash value, but is the most expensive. Universal life, what you're doing is the return is not a guaranteed return. It's tied to maybe the bond market or maybe the stock market or a combination of both. And so if the returns are good, it could give you extra benefit or maybe cut your cost. If returns are poor, you might have to ante up a little bit more premiums. So if you get a universal life policy, I strongly recommend you get a guaranteed universal so that you know what the worst case is. And for permanent policy, the guaranteed universal gives you the most bang for the buck. You put in X amount of money, and you know even if the investment experience is not good, you're getting a lot of coverage, okay?
Yeah, so just to give some real life examples here, I to simplify it a little bit. So, when you think of whole life, think of a mortgage, right? It's like, buy a house, you have a mortgage, you can, fixed premiums, you pay that over time, you build equity over time. That would be whole life. The universal would be more of like a light switch that has a dimmer on it where you can kind of control. It's not necessarily just on or off. There's some flexibility. You can control how bright the light is or how much coverage there is over time. And the indexed universal, it's like, you think of like maybe you're on cruise control with some guardrails. There's some participation in market upswings, but there's some protection on the downside.
Yeah, I'm not a big fan of indexed annuities, indexed universal, because you're taking universal, which is already subject to change, and then you're adding some more a complication.
Yeah,
it gets more complicated. Yeah,
sure.
We did a deep dive on it's about indexed annuities, but a lot of the same
very
things
similar
apply
concept
in another podcast
Sure.
episode that people can check out if they want a deep dive on how some of that works.
So let me just give you an example where you might use a couple of them. So universal, like the guaranteed universal, if you want permanent insurance and you want the most bang for the buck, that makes sense. Whole life might make sense if you have a business. And like Nick was saying earlier, maybe your business is growing over time, and you want to make sure that insurance is there and maybe grows a little bit with business. Whole life it might be more.
Is that what people are typically using in like a standard buy-sell agreement? Would be like a whole life?
It depends, but it can be used because it's you pay more, but you get a little bit more
sure.
too.
Okay.
Right? So the only other thing I wanted to add is that if you're getting a permanent policy, I think it makes a lot of sense to get a long-term care rider, okay? And what that is let's just assume that you have $1 million policy, okay? And permanent policy, and then you go into a nursing home. What you're able to do is, let's just say you're in a nursing home for 3 years, and the cost for those 3 years is, say $500,000, okay? So what you can do is you can pull money from the permanent policy. That $500,000 will pay the long-term care, and then upon death, you don't get $1 million because you already used $500,000. You're just going to get the $500 that's left.
Sure.
But what that does is it pays you ahead of time when you have the need for long-term care.
Now, correct me if I'm wrong here, but that has actually become the more cost-effective way of insuring against the risk of going to a facility.
If you're getting insurance, yes, a permanent insurance, put a long-term care rider, it's a very effective way of covering it.
Gotcha.
Yeah.
That's compared to, of course, a traditional long-term
right.
care policy.
And the other way of looking at it is, say that you didn't have the rider, so then you are taking out of pocket that $500,000, right? You're paying that out of pocket, and then upon death, then that money comes back into your estate. But you may have a lot of compromises because you're bleeding your assets.
Now, the thing that I will just really emphasize here is very situationally dependent, right?
Yes.
Some people, and we do this analysis in our retirement plans for our clients, but some people, we build very conservative retirement plans. So when we tell them, hey, you're on track to self-insure the risk based on the healthcare stress test that we use, what we're really saying is you don't need to worry about buying an insurance policy. Not everybody's in that case. So there are situations when insuring the risk does make sense. And this is one option specific to the long-term care, one option or policy that you could use.
Right.
So that was a kind of a helpful breakdown on the different types of policies, intended use, general suitability. How do we assess, how much life insurance somebody needs. And I'll pass that one to Nick.
Kind of builds off what you were just saying. It really depends on the purpose that you're buying the insurance for and your other circumstances. So think about our three areas, right? So if you need it for business continuity, you're going to project what you need based on, like Ron alluded to before, the projected growth of the business over time and how the ownership of the business is structured. If you're buying for estate planning reasons, what's that estate picture like, and the expenses and the cash that's needed to settle things up with the estate. A more common example is for income replacement is typically what we're advising people on most frequently. So for example, a younger couple married with kids who's still working, they're thinking about, what do you need to replace income? What do you need to fund kids' education, like Ron was talking about? What do you need to support retirement goals ultimately if one spouse is bringing in less money or if one spouse isn't working, because of something. Rule of thumb, for a lot of situations, it's 10 to 15 times income. So, if the household's making $100,000, you may need, $1 million to $1.5 million of term insurance, but that's heavily dependent on whether you have other financial assets and what your goals are.
Okay, so, and I think you just answered the question, but I'm going to ask it anyways.
Yeah.
So that rule of thumb, is that more applicable to term, or would that be more applicable, or would that also be applicable to like a permanent policy as well?
The 10 to 15 times income, we're usually having a conversation in the context of term insurance.
Gotcha.
But yeah, you could think about it as the death benefit, but usually that's a term.
Sure.
coverage.
Let me give you an example too. We mentioned using it for estate planning, so let me just give you an example. Say you have a couple worth $58 million, and they can exempt $28 million, the federal exemption. So that means that $30 million is subject to estate taxes. The estate tax being at 40%, upon death, there's a $12 million tax bill, okay? If their estate is liquid with stocks and bonds, it's very easy to pay that. But if their estate is illiquid with real estate, maybe business, it's not readily available to pay that tax, and that's an example of when you could need insurance for estate purposes.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So some people, will often ask, especially during their working years, should they go out, should they shop for their own policy, or should they rely only on, the discounted insurance that their employer would provide them? Ron, I'll give that question to you. Is employer-provided life insurance enough for people?
The answer is no, and let me explain why. There's nothing wrong with getting life insurance through your employer. Absolutely nothing wrong. But if I give you an example, I think it'll tell you why you want to have it outside of work. So let's just say that you have all your insurance through your company. Say you become uninsurable. You have cancer, thank goodness you were able to beat it. But now the insurance companies look at you as high risk. And so some time goes by, maybe you lose your job, or you leave and maybe you want to start your own company. Well, in either case now, you don't have any insurance because you're uninsurable.
Okay.
And your insurance was tied through your company. And so your coverage disappears. So what makes sense in this situation is to get some term policies on your own, again, very, very low cost on a relative basis, and maybe have a little additional insurance through your company, but have most of your insurance not tied to your employer so that you have flexibility, should you start your own company, get fired, decide to leave, whatever.
So it's we use this saying all the time when it comes to the stock market, right? Nobody has the crystal ball. Nobody can predict the future. It's the same thing with insurance.
Exactly.
Nobody can predict the future. This is a conservative way of managing risk.
Absolutely. And I don't necessarily think it's more expensive than getting it through your company anyway. If your health is really good, it actually can be cheaper to go on your own because your company policy is a pooled policy, okay? Meaning that they average the risk of everyone. But if you're very healthy, you can get it, probably cheaper on your own. Now, if your health is so-so, it might cost a little bit more to go on your own, but it's still worth doing.
Now, would you use the company insurance in addition to a private policy, or are you saying just kind of like ditch the company policy altogether, go completely on your own?
Depends on circumstances, but there's nothing wrong. Like, for example,
The cost of coverage through the employer, things like
there's
all of
nothing
that
wrong
needs
with-
factored in.
Right. There's nothing wrong with having a little bit. Like, a lot of times companies will give you some coverage, a minimal amount of coverage. There's nothing
It's like
wrong.
50,000 or something like
50,
that.
100, whatever. Yeah, and there's nothing wrong with adding on to that. But it's circumstances. It's your personal circumstances. So it's hard just to say one way or another. But mostly outside the company, maybe some in.
Perfect. And once you get to retirement, Nick, I'll pass this back to you. So, what happens to life insurance in retirement? Do people still need life insurance once they retire?
It depends on the need that caused them to purchase it in the first place. So when we're talking about that term insurance for income replacement, if there's no income to replace anymore, or the portfolio is replacing that income, kids are launched, education's paid for, then no need for insurance anymore, and the term can be allowed to expire. It doesn't need to be replaced or anything like that. It looked like
I was gonna say something relevant to the term. We actually, Nick and I were working on a case not too long ago. One of our clients, they had some term left over from when they were working that didn't expire, and they got the letter basically saying, "Hey, you could renew this," and of course the premiums went up
Dramatically.
And so we dug a little bit deeper. We figured out kind of what the objective was for entertaining the idea of renewing it. And we found out that it was more so for like estate planning needs. And we looked at the retirement plan and we said, hey, look, just save the money on the premiums. The financial worth, that the assets are going to be there. Your assets will be your estate. You don't need the insurance for that. Just keep your it'll help improve your cash flows in retirement, and it'll keep the estate intact just by not renewing it. So that's very relevant to term.
With the other issues, like Ron's estate tax example is a really good example of an estate planning case. The need for that would not change in retirement, obviously. Likewise, the business circumstances would dictate anything that was needed for business. The other thing is just for other types of sometimes it does make sense in retirement to keep permanent insurance because folks want to leave a certain amount of legacy behind per their estate plan, and that can be another reason why you would adjust or keep permanent insurance there.
Right. If the goal is to leave more than the safety margin, the value projected to be left over at the end of your plan, that's when the insurance conversation can come back into the fold.
If you want more than just leaving your financial assets, maybe your house, and you want some extra insurance, right? But like Nick said, it just depends on what your goals are, right? But if your goal was income replacement and your assets are very sufficient to cover your income replacement, probably don't need it.
Yeah, now, if your assets aren't sufficient, like when you were getting into those stress tests, that's where the conversation becomes about those long-term care considerations and also potentially even surviving spouse, especially if there's difference in life expectancies due to ages and health factors and things like that.
Sure. So there's a common term that is going to be relevant to somebody that owns an insurance policy, which is an in-force illustration. Now, I know that we're requesting those for our clients that have life insurance policies because there's a lot of information on there and it helps us make decisions. But Ron, could you unpack that for us and explain what the in-force illustration is and why it matters?
Sure. So an in-force illustration, and I'm going to kind of pick up from, give some examples, but pick up from, if you're retired, you have sufficient income sources and assets to meet your goals, and you have this permanent policy, what to do with it, okay? So you request from the insurance company an in-force illustration, and it basically just tells you what's likely to happen with the policy from now until death. What are your premiums going to be, what are your cash value, your death benefit. And so what we're able to do with that is figure out an expected rate of return. How much benefit you're going to get compared to your, the years you have left, okay? And so you may not need the policy, but if the expected rate of return is pretty decent, you might want to keep it anyway, okay? And on the other hand, if the internal rate of return's not very good and the you're paying premiums and you don't really need it, you might just want to cancel it, okay? And there's also in between, like recently, a client of ours, she was paying a very, very high premium for not much of a death benefit. We did this review, and what we decided to do was reduce the death benefit, stop the premium payment, and by doing that, the rate of return for her was adequate enough to keep the policy.
Right.
But now she doesn't have to make all these premium payments. So that's an illustration for someone retired that has a permanent policy. But even if you're not retired and you have a policy for business continuity, estate taxes, or whatever, you want to do this periodically because you want to make sure that the policy is going to be in there when you need it, right? So if you get a universal that's underperforming, say that you didn't get a guaranteed universal, but just a regular plain Jane universal, if the returns are very low, you may find out in 10 years that you have to pony up a lot of money to keep this in force or it disappears on.
Sure.
So you got to stay on top of it, especially with these more flexible policies.
Yeah. So, I think that the key takeaway there is that life insurance is not a set it and forget it.
No.
It feels that way, but it's not.
Right. And the reviews are important because you need to confirm that the coverage is still adequate and it fits your situation. Make sure that the payments for the policies are still on track. And like you said, Ron, with that reduced paid up insurance example, adjusting the funding or the structure of it as needed.
Yeah.
I lied. I do have one more question I think is worth asking before we close out. And that is, do you guys ever see people making big or common mistakes when it comes to purchasing life insurance?
Well, I think the biggest one is not having enough. Like you need to make it related to your situation and appropriate for your situation. That's first and foremost, right? Have enough coverage. Then from there, make sure you get the right type of coverage. Some agents, no matter what your circumstance, they think permanent's the best.
Mm-hmm.
Yeah, I don't know if that's true. We work with an insurance broker that we do the needs analysis, like and then we talk to them about the best insurance and the best cost to get, and we can look at 25, 50 different carriers, right? And then on top of that, as we talked about before, reviewing it, making sure it's you're doing the in-force, making sure it's always relevant to your situation. Anything, Nick, that I may have forgot?
Yeah, I think Ron covered most of it. One thing I build on what he was saying is there are some very complex insurance products out there, especially once you get into the universal life and your next universal life world. And I think as a consumer or a person shopping, just be mindful of the fact that a more complicated process tends to make the ones that make the most money for the issuers, the salespeople who are selling them. So when you get something put in front of you that's really complicated, that's what people like us are here for. Like, come get a second opinion on it. As you can see from this conversation, we're all about running the numbers on stuff.
Yeah.
And just don't rush into something, because sometimes I think people, I use this phrase sometimes. It's a little morbid, but like, you don't need to hunt a deer with a bazooka.
There you go again, Nick.
With the analogy. You don't need to hunt a deer with a bazooka.
It's a right tool for the job, and we're here to help out. That's a big thing.
Is an AR okay?
Yeah. Better than a bazooka, right?
Oh my gosh.
So just making sure you have the right tool for the job, which goes back to everything we've been saying the whole time about right product, right analysis, all that stuff.
And that the product thing, like you said, Nick, like our process for determining whether insurance is appropriate is very comprehensive. And if it's appropriate for you, we're going to tell you. If it's not appropriate for you, we're going to tell you. We look at it when it's appropriate as more of a strategy, less as a product. Mm-hmm. Yes, it is an insurance product, but it's fitting into your whole situation, i.e. the strategy. So, we hope that you found this episode informative. If you like the show, like and subscribe. If you feel like anybody would benefit from hearing this topic, please feel free to share. And per usual to our clients, please do not hesitate to continue sending in future episode ideas. and we hope that everybody enjoys the holidays with their family. Thank you for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.